Okay, hey everyone, Eddie again. Spreads. Now, what happens if our short strike is breached, or what happens when the underlying actually moves against us? We do. We sometimes, and it all depends on volatility and where the market is and how far away has it moved from us. Um, we will convert our credit spread into an iron condor for, or we will roll the spread in time, meaning we will take it out from this current month and then we will take it into the next month, um, or whichever month has enough open interest and volume. And I'll show you how we do that. So today I'm going to take you to my paper trading account because I really want to put this spread on, and I want to show you how do we manage the trade. Now let's go on the platform and then take a look at it. Okay, so here's the paper trading account. You can see it says simulated trading on top left here. Um, Slightly different view because I don't really use this. Um, I've just opened this up so I can put a trade on and then I can show you guys. Obviously, when we will be live trading, we will have live positions on, so it will all be on the live trading account. So today I'm in here. I've got the ES options going again, um, and just remember, the paper trading account is good, but the problem is it's very different. It's first of all the data is delayed. All the data is like delayed by like 20 minutes or something. And, the orders just fill automatically like right away. So these are not real fills, obviously. But it's good to like learn. It's to like learn everything. Now my view is very different here. So I'm going to bring my actual view here, which is the delta, the Greeks view. And then I also want to add, I don't think you get open interest by default. So you can just add open interest. And if you want a demo on how to customize your columns, I can do that for sure. Just leave me a comment. Okay, so here we are, 56 days out, ES options. The underlying is still the December contract, which has the highest volume right now. So in the futures market, the front row will always have the chunk of the like 99% of the volume. You see the contract after that, the March contract, is only thousand volume here, 1,000 contracts. Um, but that's the futures part. Now the options are different. Obviously, options have all these expiration cycles, have different open interest and volume. So I just picked one up, which would be the case if we were putting the trade on right now. 56 days out like that. Let's try and find our deltas. It's 17 here, $4,000. Now the market was down quite a bit yesterday. It is also down today. So really good opportunity to sell some puts here. Risk reversal. Like I said, we are market contrarians. We go against the market trends and we pick up some premium. $20 wide. We're collecting 225. Let me see if I can change it to 250. Let's analyze the trade. Okay, these are slightly off. My price slices are here. You need to open this up. Again, the markets are closed, so the numbers are probably off here. Now, this is not showing the right. It's taking me down to 37.41. That's a little bit off. But we'll take the trade for demo purposes. It's fine. 12.16. I want to make sure I have 12.16 here. There you go. So now if you see my percentage, it's 82.79. That's like above anything above 80, 81, 82 percentage points. That's the area that I like to play in. We will be collecting 125, which is exactly half of what the premium says here. Now let's see if you can get filled. If I confirm, my buying power is $204. Perfect. Look at the ticket, right? Try to understand this ticket as well. This is the order ticket. Like there's nothing complex about it. Let's go through it line by line. Order description. You're selling one vertical in ES in the December contract. These are your strikes: 4,000 short strike, 39.80 long strike. You're collecting $2.50. Fine. Next slide, break even. So what you need to do is from your short strike, which is 4,000, you deduct 250 and you get to 3,997.5. Meaning you went further back to $2.50 to get to your break even. Max profit, obviously half of what you collect. Max loss, out of the $1,000, you just deduct whatever you collect. So you deduct your max profit and you get to 875. That's your max loss. Cost of trade, we know this. We know this number because we've already discussed it. So we're collecting a credit of 125, but we also pay a commission fee of 450, and then this is the NFA fee plus the exchange fee, plus some this is another Globex exchange fee. I don't really understand the Globex one. Why are these separate? I don't get it. Anyway, NFA is the National Futures Association's fees, something to do with them. Anyway, in the end, we will collect $119.38 out of the 125. This is our take-home money right now. We put down $204 to get this trade going. Your buying power for stock is reduced by this number. Your remaining buying power for options is also reduced by this. I mean, this is the money that you have in the. Maybe we can discuss this later. So let's send this. There you go. It gets filled right away. See, this is the bogus part about paper trading. Where is it gone? Unallocated. Yes, there you go. This is the trade. And my columns are out here as well. So I need to fix my columns here. See, I don't have them. I don't have it fixed because I don't really use this. And I should have done this before the video, but okay. And do we need the days? I don't think so. Trade price, quantity we do, mark change. I think there's another thing called mark change percentage. Yeah, this one is what I need. There you go. Let's see now. Okay, so we have delta. So we have delta. We're basically flat delta, I would call it. Really, really small delta. We have theta, we have vega. Short vega, obviously, because we're selling. Long theta, because we're selling. P&L right now, nothing. Buying power effect. Now, this is something else. This is not your margin amount. This is something else. And we can discuss this later, how this gets affected. Mark change. Quantity, you did one contract. Trade price, this is what you traded. The long and short of it. And this is what it's marking it at right now. Okay, so that's that. Now, let's go into the Analyze tab. So your trade is on. This is how you know your trade is on. If you change this now, it's down a little bit. This number is down a little bit, which is fine because we collected some credit and then we paid some fee. Okay, the next thing I want to show you is, so what happens if it gets tested? Meaning, now if you look at this trade tab here, in this cycle, these two legs are going to show you where you stand or where your trade is. So you're trading short and long at these strikes. Fine. These are still at 70 deltas, and my long strike is at 16. Totally fine. Now let's say now we are long here, right? So let's say the market goes down and the market is sitting at 4170 or 4200, which is 32 deltas right now, but it will be closer. This number will change when the market goes down. Anyway, the point is, what are we going to do then? Do we have a plan? Yes, we do. So, if today was the day when the market would have fallen, right, and then would have tested a short strike, I would have gone in and sold the other side of it, meaning I would have selected almost the same deltas. So I would have selected 4580 here. $45.80 and then 4600. This is our call spread. Now we will sell the call spread. We would have sold the call spread. Our threshold, when do we make this change? Well, it depends. How much is the underlying down by? How much money are we out by? I normally wait until the amount of credit that we received, the P&L loss has to be twice the amount of credit that we received. So, for example, if you received $100 for the credit spread, the first leg trade, I would wait until our P&L is out by 200, and then we will convert our single spread into a iron condor, and then you'll see the numbers change. Now, when you do this, you're basically flattening your deltas, you're flattening everything other than Vega, because you're collecting more short Vega here, right? So you are betting more on the short side of volatility, which is a good thing because when the markets are down, volatility goes away. So we'll be collecting more money on the, now I'm paying a little bit more buying power because I'm selling both sides of the market now. A lot of credit here on the call side. And then let's see, let's sell it. There you go. This screen shows us that it's filled. Now it's coming as a iron condor. Now if you want to check the actual probability of making money, that number is going down to 58. Now that because you've sold both sides of the market now, so the chances of this this spread or this iron condor or this underlying staying within your strikes is about 60% now. This is one way we manage our trade. We then sit with an iron condor. The other way is we move the strike out in time, so and we collect more money. So right now we are in 56 days. We would likely, if it gets really tested, we would likely go into the next cycle, which is 91 days out, and we will collect more money. By collecting more premium, you are widening your break-even points. So, for example, before the break-even point was at somewhere here, when you collect more money in the trade, you go further back here, so you give yourself a little bit more room for error. If the strike keeps going towards a short strike, if the other line keeps going towards a short strike, you have more room now to, for it to keep coming at you. And then what happens after after the spread is converted into an iron condor? We then trade it as an iron condor. So we don't always go in as an iron condor, go out as an iron condor. We might take these spreads off individually. It just all depends where the market is going. I just want to show you guys what is our risk management tool here. And trust me, all these things work because I have been doing it. And this is how we manage it.